So today we have a great lineup of seasoned and experienced tanker experts. Joining us is Ben Ognibene from Heidmar.
That's right.
Lois Zabrocky from International Seaways, Bob Burke from Ridgebury Tankers, and Harry Kosmatos from Tsakos Energy Navigation. So I'd like to start with a broader sense of where we are in the crude tanker cycle and work our ways down. Hopefully we can get a sense of the state of demand for crude tankers currently and help us understand the future prospects for the sector. So to begin, I'd like to ask our panelists, starting with Ben and working our ways down, where do you feel we are currently in the tanker cycle? And are there any near-term catalysts which could help to move the needle?
Okay, that's a good question. I guess if I can't say I don't know, so I would say if I had to choose between up or down, I think we reached the bottom of the market this past summer, and that I think 2018 is going to be better than 2017. Demand is very good. They've revised demand upwards recently. The order book obviously is still very healthy. However, I would point out in 2004, the order book was 11% of the fleet, and we went through some very good times in the following years. So I think that we reached the bottom this past summer, and that the winter is going to be good. I don't think it's going to go bananas, but the market will improve.
Yeah.
Lois?
Yeah. Thank you. So I would echo a little bit of what Ben is saying, and what I think is interesting on the large tankers, or the Vs, in the third quarter, you really saw a period of time where rates were in the single digit, where you were actually below $10,000 a day, or right around earning OPEX. However, right now you're starting to see a little bit of a turn and a flurry of winter cargoes, and you're seeing the market pick up to close to $20,000 a day on the Vs. And even though we've had around 50 new building deliveries this year. So I think that reflects the strong demand growth and shows you that you still even have some volatility even in the midst of absorbing all those new buildings.
What they said. We feel the market going up the past week or two. As Lois said, the numbers are getting close to 20, and it's early in the year for that. We see the Chinese coming in for a lot of, the rumors are the Chinese will be in for a lot of cargoes over the next 4 to 6 weeks. But in a bigger picture, the tonnage is being absorbed. And at the end of the day, we're a demand-driven business, and there's a consistent increase in projections for oil consumption over the next couple of years. Every time the IEA comes out, there's a number to the upside. And of course, what we do is we're ton miles, not just tons. And the ton miles are on the way up. So, like most ship owners, we're always optimistic, but I feel that we're either at the bottom or very close, and the next few months will really tell the tale.
Does this work? Hello? Okay. No, I will totally agree with all the fellow panelists here. It seems that we are at an inflection point. We are out of the woods almost. The last 6 to 9 months have been difficult, not so much because of demand, but primarily because of supply, the usual case in shipping, in tankers. I mean, everybody talked and freaked about the order book. I mean, let's not forget the order book today is the lowest, one of the lowest order books we've seen in recent history. The problem is that the majority of the new buildings came in at the same time, and that kind of destabilized the market. Once this goes, and we expect to see the current order book getting delivered over the next, by the first half of 18, then we will end up with almost 2 years of zero growth. Certain sectors could even have a negative growth, particularly with vessels over 15 years of age. I mean, today in the fleet, in the tanker fleet, and we're talking about an order book of 10%, and 17% of the current fleet is over 15 years of age. So this 7% differential is to the benefit of primarily the crude tankers. So we're very optimistic for the future, at least for the next 2 years. That's how, as far as long as we can predict in shipping. And we are, I think, ready to take off. And if investors had the same kind of sentiment, then this room should have been standing room only, not only the dry bulk panel, but also in the crude panel we should have more zest from the investor community, which they have been burned in the general energy sector the last couple of years, and they never bother to do the research to see that tankers, all tankers, were a natural hedge to the fall in oil prices. But that nevertheless, we are, I think, we are ready to take off, especially, after the beginning of the new year. We should be in really healthy territory.
And just a couple of things to pick up on what Lois and Bob said. We haven't had a traditional, I guess, winter in the last couple of seasons. So we're heading into the winter now. Flat rates have already adjusted or will be adjusted up 15 to 20% next year. So that, with some traditional normal winter weather, with those flat rates going up, that can provide a catalyst which could propel the markets.
And I'm sure you've all seen scrap is over $400 now, and there were 2 V scrapped last week and 2 Afras, and I just sense there's a lot of pent up, a lot of owners who are ready to scrap at these levels.
And with all this new water ballast, coming in 2020 or thereabout, that should incentivize owners of that vintage tonnage to either scrap or depart from the competitive environment. So things could even get better from what we expect.
All right, thank you guys. So Bob, I don't want to pick on you, but so this
I'm ready.
A thick skin.
So we've been hearing about scrapping of the older tonnage, which is going to help alleviate some of this supply-demand imbalance. And everybody's targeting the older vessels, 17, 18, 19 years old. Ridgebury currently operates a number of 17 and 18-year-old vessels. So can you kind of explain to us your thoughts on how to manage these vessels up to their, I guess, 20th year special survey?
Sure. Well, scrapping is an interesting thing. It's not the absolute price of scrapping, it's the spikes in the scrap market that make people move, because if we always knew scrap would be at 400, then we could count on that, but it's the moment in time that you're afraid you'll lose a year or two later. But how do we manage them at that age?
Yeah,
they're a slightly different market. I mean, they're not the most preferred ships. Older ships over 15 are not the first ships to fix, but they have different markets than the newer vessels. They absolutely have a place in the world. The ones that are well maintained are able to fix. The ones that have vettings are able to fix. And most of the oil companies will fix ships over 15. One of ours was onto a major for, I think, close to 18 months recently. Most of the traders will take them. So it has to do with how they're vetted, the pedigree of the owner in the ship. It also has to do with the market. It's like the rainy day in New York with the taxi cabs. If it's pouring rain out, then you take any taxi cab that comes by, and if it's a beautiful sunshiny day, you take the newest one on the block. So when the market is very good, they trade like every other ship, and when the market's not so good, they trade at some slight discount. But the pools have a mechanism that accounts for that, and the pool point system accounts for the age and also for the increased fuel consumption. But for us, it's an economic decision. I mean, it's purely math. What's she worth as a resale or as a sale or as a scrap, and what's the underlying scrap value, and how much are we paying for that optionality in a volatile market for the next 3 or 4 years? And what we find is it can be a good investment if the assets are managed correctly, if they have good technical management, if they have good commercial management, if they have good vettings. If you put the money into them, if you put the money into the equipment, into the steel renewal, then you have an asset that can earn nearly as good as a newer asset. And if your underlying exit is, or underlying asset price is scrap or some larger or some slight multiple to that, then you're buying the volatility of the V market for your cost of capital. So for a lot of things that we look at, it's better than buying a brand new asset for $80 million and carrying that capital cost, which, as we all know, is very expensive. So it's a different investment mentality, but it's one that has been successful for us in a couple different areas.
Lois?
Just to add to that, there's a lot of these that are between, over 20 to 25 years old that would be up for scrapping, before you get into the into the teen years. Essentially, on average, tankers have been scrapped at about 25 years, except for when you go through the dry spell, and then it moves down a little bit. But it's pretty, the only V's scrapped this year, there was one sold in 1999, but that's the youngest V that we've seen scrapped.
Harris? You have a 1999 V, right?
Sorry?
Tsakos currently has a 1999 V.
Well, funnily enough, on the private side, they did scrap a VLCC last week, but a very old one, not for the likes of 10. Obviously, the acceleration of scrapping will help the industry, as any other measure that takes tonnage out of the market. As Bob said, it all depends on an owner's philosophy. I mean, there will always be a home for all the tonnage. The point is not to have them around us, competing with us, competing with the modern, tonnage. And in the end of the day, it all depends on the investment philosophy of the company. I mean, in our case, as 10, we take more of the industrial approach, the long-term contracts to the very solid oil concerns, and offer a dividend, more or less as an annuity, if you like, to the shareholders through the visibility that we offer in terms of time charter coverage and the revenue backlog. If, however, you're more of a trader, then playing the asset game between 15 and 70-year-old vessels could be optimal. Obviously, it could backfire if markets go against you, or if these new regulations exceed the budgeted cost that you had in mind. These are unknown today, so perhaps even though this game had been very profitable over the last decades, if you like, and this is how Greek shipowners traditionally made money, by trading older vessels. Obviously, this could dissipate in the future, but there will always be an angle for this kind of tonnage. They will not, and as I mentioned earlier, 70% of the fleet today is over 15 years of age. Admittedly, not all of that will be scrapped overnight, but it is important that it's not around to compete with companies like ourselves.
But let me, if I can. My Greek friends have made a lot of money in the older tonnage, and the end-of-life asset game is very well known to Wall Street. And they've made a lot of money in the airplanes, and the rail cars, and trucks, and the yellow equipment, almost every asset class. They haven't made any money in the shipping business because basically they don't have access to that asset class. Most of the public companies like to tell you how young their fleet is, which is great. I mean that seriously. Many Greeks have made money in the older asset class in tankers. So we at Ridgebury have been able to do is to bring access to that asset class to Wall Street money, and a management team that knows how to manage it, because we have good relationships with the commercial and technical managers, and also good relationships with the public companies who feel that they look better to their investors that have a newer fleet. So we to a large degree copy what the Greeks have done for generations, and with our background here in New York, we try to bring investors who want access to that type of a risk profile to our company.
Yeah, and I'll just add that Heidmar manages a number of older vessels, including Bob's and some of Lois's older Aframaxes. And there is a group of charterers who will charter those vessels, provided the quality is maintained. So you can build your strategy around those charterers. And actually, a couple of the older VLCCs are our highest performing vessels this year in our V pool. So you could be effective, and I think the idea is that you get them in the right place at the right time, and then when the market spikes, you can do just as well as any other ship, including the modern vessels.
Yeah, great, thank you for that. So, moving on to the commodity itself. So as we saw in the price collapse of crude in 2014, tanker rates recovered greatly. Do you think there's a sweet spot for crude to help the tanker market, I guess, have sustained earnings power? Ben, if you want to start.
Good question. That's a tough one. It's funny. If the crude price is down, you get storage, which is good for the market because it eats up, obviously, tonnage supply. When it goes up, its demand is good, which means oil is being consumed and traded and refined, which is great. I would say a price that enables, I guess, U.S. production to continue, as well as OPEC maintain or grow their production back to what it was, would be fantastic. Whatever that range is, I don't know.
Yeah, I mean, I think we're close to where a sweet spot is, like between $50 and $60 a barrel, because oil demand growth year on year. That's what we need. So we have ton mile growth, and you want emerging markets to be able to grow at a maximum rate. And why you've had 1.6 and 1.5 million barrels a day year-on-year growth is really because oil prices went to 50% of where they had been for a long time, and that was cutting into the oil demand growth. So it's the consumer, it's the demand. The emerging markets can afford, you have more crude oil permeates the market when you're around this level.
My answer is as confused as everybody else's because the answer is it depends. If crude prices go through the roof because economic activity is through the roof and the world GDP is huge, then it's great for everybody. If there's too much oil in the world because there's more production than anyone can find, then it's not as bad as when crude goes to the floor because there's no economic activity. So it depends on what's driving the price of crude, I think, more than anything else. And
well, I think prices in the bracket of 55 to 65 are very healthy. Historically, we've seen that prices need to be over $80, $85 to start creating some demand destruction, and ultimately have an impact on rates. But anywhere within the current levels, we think is very healthy. It stimulates demand. And also, we need to pay attention of the price differential between WTI and Brent. Obviously, if it's above $2.5, $3, that incentivizes especially the Far Eastern buyers to buy oil from the US, and we have seen this trade developing. So that's something that we should pay closer attention to as we move forward. But we don't see oil prices go north of 65. You have all this incremental demand that it's outside the OPEC cuts, Libya, Nigeria, the US, of course, that they put a natural lead on any rally, if you like, on oil prices. So we, at least for the foreseeable future, we see that oil prices in this range will create a very healthy demand, and we're seeing that. I mean, the IEA has increased their forecast for next year from 1.3 million to 1.6 million in terms of global oil demand. So we are, it seems that the stars are getting aligned.
Okay, so let's discuss the U.S. crude export. So, we're allowed to export crude globally now. Like you mentioned, the WTI Brent spread, it's about close to $6 last week.
About $6 a day.
Yeah.
But above 2.5 to 3, it stimulates.
Stimulates. So have you seen more inquiries on for more U.S. cargoes, particularly light sweet to the Far East destinations? Or have you seen more inquiries on the heavier side of the crudes? Harris, if you want to start.
Not necessarily. I mean, we've seen it in the market. I'm not talking 10 specific, but we're seeing, for example, apart from the standard, if you like, the original, the U.S. to Asia to the Far East route. Now we're seeing U.S. cargoes going to India. That's a new route that didn't exist at all. Now with this differential, a number of Indian refiners are importing U.S. oil. So that's something that assuming that price differential remains into this kind of levels, we're going to see, been solidifying as a new trade, if you like. So that creates more ton miles, it takes capacity out of the market, and hopefully that will give an uplift in rates and eventually asset price as well.
Bob?
No, no, nothing to add, but just by way of some color, $6 a barrel is $12 million for a V, which leaves a lot of freight to get from the U.S. Gulf to India, and still a huge profit margin for the refiners compared to bringing it out of the Gulf.
Lois?
Yeah, I think what we're seeing is a lot of variation. So we went over 1 million barrels a day for 1 week, and that's because of, I think it's because of that huge difference between WTI and Brent. So we're not reliably, at 1 million barrels a day yet, but we keep flirting with it in 2017, and more than half of those exports go to the Far East, probably including India, if I'm accurate in that number. So, it is definitely something you continue to see increasing. So.
I mean, this time last year, the U.S. was exporting 500,000 barrels. Today, or last week, was 1.5.
Yeah.
So okay, this will not necessarily be maintained, but at least you see the trend.
And
Yeah.
part of that was driven by, of course, the hurricanes, because the refineries are shut and the crude gets shut in. So then the price drops and then it goes to the Far East or to India.
Yeah, and what we also have seen recently is Suezmax inquiry going to Asia and particularly China, where they've struggled with delays at the terminal. So if you can take a Suezmax, less freight, less demurrage, and quicker time in and time out in and out of the port. So we've seen that happen. And also inquiry to Japan for U.S. crude exports on VLCCs, which is interesting.
And Ben, on your Suez, you don't have to lighter, yeah?
Don't have to lighter, so you can load and then go right into ports in China as well.
We have a lightering business. You should definitely use V's.
All right, yeah, that's right.
So there's also Occidental Petroleum. They're building out the Corpus Christi terminal to handle laden VLCCs. Do you think this is going to help spur additional U.S. infrastructure to handle larger tonnage for U.S. exports?
No, it should definitely. If you can, if like Lois said, if you can avoid the lightering cost to top up a VLCC, then you should have obviously lower freight and cost of delivered crude in China or wherever. So, yeah, I think so.
It's hard to imagine worrying about permits for an infrastructure project being prepared and for a business in the short run. I mean, theoretically it should, but it's hard to get anything built.
Thanks.
No, President Trump has been very pro-infrastructure, so I think this is part of his agenda for as long as he's around. And why not? I mean, it's a market for the U.S. That the U.S. would like to cultivate and develop.
Okay. So let's switch gears and talk about China for a bit. China's always been the big story in shipping for the past, I guess, decade. And a few years back, the story was around the Chinese teapot refineries. Now they're building out these mega refineries with 400,000 plus barrel per day output. How do you think that's going to shape the crude trade?
Well, I mean, the incremental growth has come from China, which is good, has been good for the market. However, at the same time, the Chinese owners have huge VLCC fleets. They have, if you remember, TradeWinds reported that article or published it a few years ago about the Chinese building a fleet of 100 VLCCs. Well, they have 100 now, and they probably have another 20 or 30 on order. So, they're a big player in the market, and they want, for strategic purposes, obviously, to be able to control the flow of oil to China. So steering around them is going to be very important when you're operating on the market. They'll send their ships west with crude to the U.S. to program them to come back with crude to China. So depending on where the flow of their vessels are, really determines where the markets are tight or not. And you have to kind of steer around them because they're such a big player in the marketplace.
Yeah, I mean, if you back up off of it, I agree with everything Ben is saying. But if you look at it, you have annually you're looking at like a third of the total incremental crude oil demand comes from China. So it's really large. Their crude production in country is declining, so that just increases the demand that they have, and then they have really invested in refineries really ahead of their own demand. So they're just pulling in that crude, and then they're actually exporting products, and that's a little bit of what has tempered the product side. But you just see them, building very strategically, bringing it on, and that's super long ton-mile demand for big ships. So that's very positive, and of course you do have to worry about the nationalism, if they want to move it on their own. But they're certainly in the top 5 charters for anybody with Suez and V's.
Well,
Nothing to add.
okay, Harris.
No, China is and will continue to be the main driver for crude oil demand. Obviously, the teapots have really incentivized or increased the thirst of China to import oil. Over the last 2-3 years, the seaborne imports have increased from 6.45 million barrels to 8.2 today. So very, very healthy import levels, and people and investors need to really pay attention on the strategic reserves. So it's not only for internal consumption, but also to build up the reserves. Today, as we speak, China has 200 million barrels of reserves. That's about 33 days of consumption. I think the national plan is over the next kind of 5 years to increase or to triple that to over 90 days. They are building another 240 million barrels of reserves. So obviously that will continue. That will have an impact on imports. So in total, they are going for over $500 million, 500 million barrels. When by comparison, the US is over 700. So you can imagine that once that second phase gets completed, then perhaps we might be in for a third phase that will continue stimulating oil demand. So China will continue to be a very, very strong player in the crude game going forward. So,
I mean, the demand story from China it seems good right now. But there's a looming threat with our esteemed president and some nations in the Far East. How real is that risk over there? Because if there is a conflict in the region, do you think China will continue to source oil from the U.S.?
I think he plays bad cop, good cop. So Tillerson is a good cop, he's a bad cop, and whether or not there actually ever is any, I don't know, but that's a...
I don't see any upside to commenting on the geopolitical situation in public.
All right, so
obviously it all depends on the availability of crude from the Middle East, because if those OPEC cuts remain, they will have to bring oil from somewhere. So it's either the U.S. or Venezuela from the long haul. But it's a bit up in the air. But
all right, so
all crises usually are good for shipping.
Yeah. Any disruption in normal trade patterns is good for shipping.
Okay, so since you brought up OPEC, let's all open up our crystal balls and look in. Do you think the OPEC cuts are going to continue when they convene in March? And how deep do you think the cuts could be? I'll start with Ben.
I think they'll continue at present levels.
Okay.
How's that? Sorry about that. I caught you off guard. Should I pontificate a little more?
No, it's okay. I mean, I'm just thinking that it has, it has to do with the balance that's out there, and we're about halfway through the overhang. So whether it's in March or it's in June, I think at some point in, let's say the first half of 2018, you start to go towards a better balance in the crude markets where they should be able to start to bring on more crude production.
I don't have a clue, but what I would guess is if crude is towards $60 a barrel, which it hasn't been in a few years, and I'm one of the minor members of OPEC, I would agree to keep it, and then I would say I would cheat, but I think there will be more cheating as the price hangs where people want it, but they'll agree in principle to get it done. That's just, thinking through game theory.
Well, I really don't have any idea today. It all depends on whether the oil prices will be at the end of the year. It will also depend on U.S. shale production and where that kind of is shaping up to be over the next few years, because that could be an impact, and that's a determining factor in OPEC making up their minds. And also for the OPEC countries to feel secure that any cut at the point that is decided will not suddenly overnight flood the market with oil and lead to another collapse in prices. So if I have to make a guess today, I would probably say that there are more chances that they might extend the cut, at least at this round, and perhaps review it later.
Well, one thing we talked about earlier, which was the crude price. I think the one thing we don't want is to have really high crude prices, where that totally cuts into demand. But you still need to have high enough crude prices where producers and countries, national oil companies, are incentivized to keep producing, because otherwise we will have the pendulum swing, and then when oil prices go high, it hurts demand. So I think it's important. It's an important part of the equation.
And also Russia. We need to see where the Russians will be. They're obviously not OPEC, but part of the cuts as an additional 600,000 barrels. Sometimes they're in favor of the cuts, sometimes they're against the cuts. So that could be another swing factor. But in any case, I don't think that come March they will. It's perhaps a bit premature, especially having reached the level of oil prices that, in a way, they were aspiring in the beginning.
Okay, great, thank you. All right, so this is my favorite question.
Uh-oh.
So we all know about what's going on with the South Korean shipyards. They've cut capacity, but most of them are out of the restructuring phase, and they've had a good first 2 quarters. But now it seems that with the steel price increases, their steel plate suppliers are not willing to give concessions anymore. Do you think the South Korean shipyards will look to add more orders with aggressive pricing now that they can't break even at the current order levels?
That's a great one for Harry.
Well, let's start with Lois.
We ordered ours. We're done. We've done 15. We're taking delivery of the last one next month, so we're done.
Okay, all right. I was going to say.
No, well, I don't know. I mean, let them build bulkers, not tankers. But
Containers.
Well, Lois, I know you International Seaways purchased 2 resale Suezes
Correct.
recently.
Yeah,
Resales, key word.
resales. Yeah.
Resales. I'm sure you have open dialogue with the shipyards. Are they marketing aggressively now, or?
The yards are still marketing, but, I actually had written down exactly what Harry said, which was, this is the first time, where, everybody's very rosy on the dry cargo. LNG is starting to get, pretty consistently rosy, and, the containers are looking up. So all of that is great. Let them build, because the worst thing was, that the yards were really starving and all the sectors were down. And then, that's a problem for us on the tanker side. But I do think with steel prices increasing and with the fact that they have sustained themselves to some degree with a flurry of orders, hopefully there will be a pause and a reset.
And it's one thing yards marketing themselves, and another for the owner to find the financing to acquire the vessels. And financing is scarce today, thank God, not available to everybody. And so that hopefully should create, no matter what the price of a new building is, that hopefully should create some restraint in en masse ordering that we experienced in the past.
No, we all tell ourselves it's the same thing all the time. There'll be no more ordering because of A, B, and C, and somehow or other ships get ordered. I think also the big issue is there's no offshore orders for the yards, and that soaked up a lot of capacity. I remember I was out in Korea 3-4 years ago, and the comment from one of the big yards was, "Why do I want to build tankers? We have all these big projects here from offshore." Well, those are gone, and I think it was just recently. Not only is Samsung building tankers, but they just decided they're going to build bulk carriers, which is sort of a step down in technology for a yard like that. So, they're hungry. And also, a year ago, I was out there, and I was told the state won't put up with it, the public won't put up with it. They're tired of subsidizing these yards, and capacity was cut 25% or 30%, whatever it is. But sure enough, we all talk about the order book constantly and know that it's an overhang. It's an overhanging threat all the time.
Okay. Well, we know the capital has left the shipping sector, but you hear a new deal every day. A ship owner who with a good balance sheet, with a long track record, they're still able to acquire financing at LIBOR +2, LIBOR +3.5, right? So, do you think those ship owners might look at this as an opportunity to get an asset at a pretty good rate for an upturn in 18, 19, and 20? Do you think those ship owners will look to go and order new vessels?
The answer is yes. Obviously, it's very attractive entry points today in new building prices. Again, like in our case, we've been very vocal, and Nick Tsakos has been very vocal against speculative orders. It's one thing to order speculatively hoping that the market will be up in the sky when the vessel delivers, and another to build against a contract, because that vessel once it hits the water, it will not be chasing the spot cargoes that all the others will. So in a way, if if you view the new building project or a new building vessel as part of an overall industrial project, it's one thing. But if you start ordering, unresponsibly, just for the sake of it, just because the prices are low, then that's very dangerous. And so far we haven't seen that. The companies that have ordered are good, decent companies with good track records. So we haven't really seen the ordering of the fringe marginal operators that the 5-vessel, 2-vessel companies that were ordering vessels. I mean, back in the glory days in Greece, you had doctors and dentists that were ordering new buildings. We're not seeing that now.
We still have more time. I see 5 up there. So if Bob and Lois, or Bob, if you have anything more to add?
No, I mean, we don't order new ships. I mean, very quickly, to me personally, to make a speculative bet on what the market's going to be 2 years from now with a large amount of capital, it just doesn't make sense for the returns. It just doesn't make any sense.
I don't have anything really to add. We're not ordering either.
Oh. All right. Right. Thank you very much. Take questions? Okay.
Have to keep
Sorry.
it.
No
You're the boss.
Very
You're the
good.
boss.
The boss.